Let's get in conversation with Sanjay H. Parekh, the founder and CIO at Soham Asset Managers, to understand a little bit about where the markets are heading, what their portfolio construct looks like, and what's the outlook going ahead. Thanks so much for joining us, Sanjay. Give us a lowdown on where you feel the markets are headed from here. Do you think we have bottomed out enough, because we had slipped below that 22,000 mark initially in the first half of the trading day? We've managed to recover only nominally from there. But do you believe that this is the worst for the market and now would be a good time for FIIs and along with them some confidence to return in the market?
Yeah, good afternoon. So essentially, our product is Nifty benchmark, where we have at least 70% always in large cap. In fact, our average large cap holding has been 78%. So I just give you a perspective of how we think about Nifty to begin with. So we think now the risk return is really favorable. In the interim, flows can have some excesses, but we really feel that we've reached the bottom on Nifty. I mean, you can never say never, but largely we think we are done, because even if you take earnings post downgrades, broadly, next year will be at 1,200 rupees of earnings, and 26-27 would be 1,350 rupees of earnings. So now we are at 18.3 times on 26 and 16 plus 60.2, 16.3 times on 27. If you take earnings yield versus debt yield, now the earnings yield on FY26 is 5.3%, which is reverse of price earning, and the debt yield is 6.7. So the gap is at a low level from where typically the market does well. If you take price to book also on ROE and cost of equity for India, Nifty, our ROEs for Nifty will be 15.7 times. If you take risk premium and tenure at 11.7, the implied growth is 10% for earnings growth. And yet it comes at 3.35 times price to book. On 26, we are at 2.9 times price to book. So historical 5-year average also you take, we are at the lower end on price earning. So I think now we are very clearly the risk return is favorable. Even we are seeing RBI has infused almost 5.7 lakh crores through CRR, VRR, OMOs, and swaps. And the government spend also has started. We are seeing some signs of recovery, and I am very, very positive that Feb, March, April, May will look further better in terms of earnings revival. So I think the expectations are also now somber. So in Nifty, at least we think that we're very, very close to the bottom, or maybe at the bottom.
All right, hopefully it does, because for now we are just sustaining that level of 22,000 marks, Sanjay. Let's see how the recovery pans out. But the markets have been really volatile off late, Sanjay. Help us understand that what recent changes you have made in your portfolio specifically, because we do understand that most of the exposure is within the large cap space. So off late, any particular additions or reductions that you have made, and if you can tell us sector-wise?
Yeah, so, I mean, we are today at 75% into large cap. And IndusInd Bank is now classified as mid cap. But if you take that, we are 80% into large cap. 75 plus 5.5% in large cap. And we have 5% cash. 13% is small cap, and around 5-ish is mid caps. 1.5 months back, we were seeing that there could be some pain in small caps. So we reduced small caps a bit by 3-4% and moved into large caps. So that helped in hindsight. But we do own today also small and mid caps at 19%. And we did take a hit as well. But the overall portfolio risk, like the whole volatility helped us for a product like us, where compared to a lot of mid and small cap funds, certainly our volatility in the performance or the fall has been quite somber. We clearly can't avoid the fall, and that's where we are. So in terms of sectoral exposures, we like financials. There's a big overweight we have. Overall, banking also we are overweight, and NBFCs also we are overweight. We like capital goods where we are overweight. Metals in non-ferrous, we are overweight on one of them, Vedanta. Telecom, we are a big overweight with Bharti and Indus. Auto ancillary, we are neutral. Pharma, we are neutral with a mild overweight. IT, we are underweight. FMCG, we are zero. Oil and gas, we have zero weight. So we do take sectoral bets to create alpha, and that's worked for us. So in this construct where we do take active sector calls, we are broadly happy with, in 2.5 years, 20% alpha over Nifty TRI. So that's the approach we have. And in mid and small cap, we believe that, we would be very selective. We will have filtering criteria, which is very hard, and seek higher margin of safety.
Okay, I just wanted to follow up on that point that you made, that you are very underweight on IT and zero when it comes to FMCG. Given the kind of recovery that we're seeing in terms of rural demand coming back in, although urban is sluggish for FMCG, and the kind of commentary that we've been hearing in Q3 from players, would you revisit this stance on FMCG anytime soon? Would there be a restructuring in the portfolio where FMCG and IT might make an entrance? IT, I understand you're underweight, but would you see that stance changing anytime soon?
Yeah, so FMCG, the discomfort is that, you're not seeing growth and the valuations are still at 40, 45, 50 times. They're not corrected as much. Even if you take a DCF in implied growth rates, because most of them should be valued on DCF basis, yet the implied growth are not comfortable compared to the actual growth rate they're showing in terms of volume growth rate. So, and the narrative or the commentary in the recent conferences also is neither very positive, as the consumption is going to be weak for a while. So we are always open to taking changes and making changes and buying at a price. But right now, at least, we don't want to revisit. We have an open mind, but, we would want to have consumption representation through, we feel even banks have a retail credit. Bajaj Finance, we own a large way, which is again a consumer play. Telecom again is a consumer play. So housing finance we have, which is a consumer play. So we would want to, autos we have, which is a consumer play. So we would want to have a consumer representation other than FMCG where the valuations are reasonable. So that's our approach.
Sanjay, with this, we'll let you go on that. Really appreciate you taking the time out and speaking with us.
Thank you.
But with this, viewers, it's now time.
If you like this video, then like, share and subscribe to ET Now.